All right, so good morning to all of you. So first, I want to know if there are any questions on whatever we did on Monday. So we have discussed chapter 2, which I would like to review today. So first I will take questions.
Yes, sir. I have several questions.
Okay, good.
So first one is from chapter 1. So I was reading the Spilsker's book, and in example 1.8, they could talk about call options.
Example 1.8.
1.8. It is on page 19.
On page 19, yes.
So they talk about call options and how to price those call options. So they introduce this the risk neutral probability measures. But my question is this call options not kind of an arbitrage opportunity? Because you are always gaining something positive.
Right. So call options will give you a non-negative payoff. But of
Yes.
course, for that, if you are required to pay a strictly positive price on day zero, which is equal to the risk neutral expectation of your payoff, then it is fair. Okay.
Okay, so there is a possibility of loss also.
No, there is no possibility of loss. The only loss that could be that you have to lose the initial price that you pay. So on day zero, for any derivative contract, you pay the price. And then on day one, when the state of nature is realized, either you get nothing. For a call option, you can either get zero or you can get a strictly positive pay. So
Okay.
if you get zero, then basically you lose the price that you paid on day zero.
Okay. Okay. For the next question, so in chapter 2, I found that the bank process is taken to be dependent on this omega, the state of nature, because we are taking this B1 of omega instead of just a
Just a
risk-free
constant.
B1.
Just a constant.
Okay, so there we are kind of generalizing the idea that bank process can also vary on the state of nature, right?
Yes.
Okay.
So I did not do that because it will basically clutter the notation a lot. So I kept to the simpler scenario. But if the simpler scenario is clear, then this generalization would be very easy to find out, because you see everywhere I actually mentioned B1. So throughout,
Yes.
if you make actually B1 dependent on omega, everything will go through. Only the state price density calculations will become slightly more complicated. That's all.
And another question is that in chapter 2, okay, so equation 2.12, I think. So let me just 1 second.
Equation, just hold on. One second. Equation 2.12, yes.
Okay, so they are, you, if you just go just the previous equation, so u prime of w of omega is lambda times L omega by B1 omega.
Yes.
So they are not considering that the utility function is dependent on the state of nature and as well as the valuation. So they are considering only the dependence through this valuation only.
Yes. Yes.
So when we are actually treating these, dividing this into two sub problems, then we are not considering the dependence
No, that
on state of
dependence
nature.
will be more complicated to handle.
Okay.
Again, in the initial phase, as I think I mentioned this, that initially we will assume that that second omega is not there.
Okay.
But you can develop the theory even if the omega is there, but of course it will take some more work.
Okay. Yeah. That's it.
And also, if you think about it, it is then a state-dependent utility, and state-dependent utility is much more complicated even to understand. So, what is your next question?
No, that's it.
Oh, that's it.
Yeah.
So, anyone else has any questions? Because I would like to do a review today, and the best review is when you ask me questions.
Sir, I had a few questions.
Okay.
So the first question or comment is that when we define the dominant trading strategy, it is not the usual dominant strategy we define in usual senses. So there we define for all, and so strategy is dominant if it dominates all strategies. And here we are defining dominant if it is
No, no, no.
dominating only one strategy. There exists.
Okay. So these two are just logical extensions of each other.
How?
So if there are dominant strategies, you basically do a kind of a supremum exercise.
Right.
So a pair where one dominates the other is a sufficient starting point.
Okay. So, but when we are saying that there are no dominating strategies, there are no dominant trading strategies, that means that all strategies are admissible in that sense.
No, the admissibility question we have to tackle separately. Admissibility is different. When I say there are no dominating strategies, I only mean that every strategy will have some disadvantage with respect to the other one. So it cannot be all advantage.
No, it can be all advantage. I get that, but can it be that it cannot also be that a particular dominating strategy is better than another strategy in all times at all times? That is weird because.
Why is it weird?
Because, for example, this would lead that a completely ridiculous player could also gain purpose. So the market does not have the potential to punish bad players.
No. What this definition actually requires is something much more fundamental. What this definition, because it's remember, now we are describing everything in a static market,
Right.
essentially static market, because there is only one day. So there is no scope of learning or no scope of pushing something out. Okay. So this definition is effectively requiring that everything that is non-optimal or everything that is stupid has already been weeded out. So they are not allowed to appear in the market at all.
But if the market is complete, then we have that all strategies are okay.
Certainly.
So in a complete market, no one can make loss. And no, sorry, my bad. No one can. So in a complete market, in that sense, the complete market never punishes.
Yes. Because it does not have to punish.
Why does it? The existence of an efficient system. Why does that ensure that the players are also efficient? That is a bad assumption.
Because otherwise they will not be. They won't be able to operate. You see, what we are defining is actually the final destination in a learning path. Because in the static market, we cannot describe the learning path. But in the final destination, all the bad things are already gone.
Okay.
So when you think of this from a real life perspective, the real source of confusion is in real life, you always see some kind of learning that happens. Some strategies are played out, they perform badly, and they are not repeated later on. And this learning part we cannot accommodate in a static mode.
Yeah, so you are essentially characterizing what would happen in the limit.
Yes.
Yeah, I get that, but even in the limit, so the limit should have the property that that if someone deviates, then he's going to be worse off. So this limit does not characterize that. So this is a how I mean how
Yes,
does it?
because we are only describing the equilibrium. So if you are thinking of this as a game theoretic kind of setup, we are only describing the equilibrium and we are not allowing any off equilibrium parts.
Yeah, so in equilibrium, equilibrium is characterized by the fact that no one can be better off by deviating. But here we are not saying that. Here we are saying that yeah, everything is fine. So this is not the equilibrium characterization which we are accustomed to.
That you are familiar with in a game theory setup. Yes, that I do admit, because there is no question of a time here. We have not allowed the time to play any role.
So even in the game theoretic setup, even in static games, time is not necessarily a necessary component for the characterization of the equilibrium.
But in a static equilibrium description, of equilibrium paths are never observed.
Yeah, off equilibrium paths are never observed because they are. It is not that they are not allowed. It is that it is not rational to take them. Here you are essentially saying that it is not allowed. That is.
No, I'm not saying it is not allowed. We are only seeing the rational part. The other part has already been weeded out completely. That's the final destination. That is the problem with this model, because there is no scope of seeing what else could have happened. There is no scope of describing that here yet. And if you really want to discuss that, then we have to allow the incomplete market discussion also, and that will really complicate matters, at least in the beginning.
So you are essentially saying since the values are stable, and hence it must be that everything bad has been rooted out.
It leads to
Everything bad has been rooted out since it is a
yes. I'm saying yes. Essentially,
Right.
this is the description of only the good part. Any other questions?
Yes. There are quite a few.
Okay.
The next question is that the law of one price does not imply dominant rating strategy. That counter example. There, all the examples I was seeing, at least in Pliska, was had H to be negative entries. So, is it necessary for that to happen to produce a counter example?
No, that is not necessary. But what is actually necessary, if you look at the examples, you will see that most of the examples rely on putting zero probability on at least one state of nature.
Right. Oh, okay. So you are essentially saying that if all the states are possible, probable, then the equivalence holds.
Yes. That's why we moved from pi to q, because
Right.
pi allowed zero values.
Then what was the next question? Oh, right. Oh, this was a more of a comment that I wanted to make, that in the last thing, not the last thing, you were saying that the relation between Q and P with respect to the optimization problem of the investor, optimal portfolio problem. It was initially surprising that Q and P are related, but they arise from very different contexts. So that was the main reason I got lost in the last class. Why how did that happen? But I came up with an explanation. It is that it is not surprising because it is for an optimal age. That is also the equation also uses an U prime V1. So the V1 is the thing that we are using. So that depends on our choice. So it is just that the optimal age must satisfy this equation. So it is a property of that optimal age, not the property of P and Q. Am I right in that explanation?
But these two are the same, isn't it? Your explanation is absolutely correct, but aren't these two descriptions the same thing?
No, the P and Q are inherently given, and then we are finding an H which depends on both P and Q. That is complete. So that H can depend on P and Q. That is fine. But
that H has come out of the utility maximization of the investor.
Right.
And that U itself is linked to P and Q. If you look at the first order condition discussion we had on Monday, this is a triplet that are closely linked. The U function itself is not free. It is related to P and Q, if you recall.
So it is related to P and Q, but it is not that the relation is absolute. I mean, that it is not that it holds for all arguments of Q or something like that. It is for a particular argument which we get as a solution of the optimal.
Sorry, what do you mean by particular argument?
So it was that U prime of U V1 is related to P and Q. So that V1 is the optimal V1 we are choosing.
Yes.
So that means that that relation holds for a particular choice of H.
And no other choice will be observed.
If all, so you are no other choice to be observed if all players are playing their best.
Yes.
So that is an equilibrium characterization. That so
As I said, this is a very strict and very narrow description.
right.
Very strict and narrow description. We don't want to allow the outer fringes to disturb us right now, because this model is deliberately kept oversimplistic so that we can talk about the major features one by one, and I don't want
Right.
things to come together and make it really complicated.
So I was mainly bummed by the fact that Q and P arise from very different situations and how can they get related. But the H, the choice of H occurs after Q and P, so it can depend on both. So that
But
was
it's a good question, and this is something to think about. Initially, it is a bit surprising. How come all these things are so tightly
yeah,
linked
yeah.
to each other?
That
But
was the main reason I got lost in the last class from that point.
and I think it's a good digression. It's good to get lost, because that means you are trying to figure out what is going so right.
Right.
Some things should be allowed to go wrong, which we are not really allowing right now. I think that was the real source of the confusion.
Right.
Okay. Uh, so, Abhinandan, any other questions?
I have not yet read the remaining parts, so no, not yet.
All right. Anyone else who wants to ask something? I know Rajesh has been able to join from today. Rajesh, has he joined? No, I don't see him. And Abhishek Panda also is not here yet. Okay, anyway, yeah. So, anyone has any questions? Otherwise, I will start my own review. Okay, so I guess no one has yet studied the material so far. So that is a caution. So do start reading, because things will pile up, and you still have 5 courses to take care of, even though there is no mid semester. But you know how things pile up, and in the end there will be trouble. So start reading, start working. So I will start my screen sharing now, and we will start our discussion from some of the additional material that I showed you on the very first day. I told you that there are some nice lecture notes available on the MIT OpenCourseware, and in particular I want to discuss a little bit, because I don't know whether you have taken a look at them, but you should. One is this lecture 14, which is the mean variance portfolio analysis, which we discussed on Monday, and the other one is in a different course, in this arbitrage free pricing. So let me first show you the course links. So this is one of the courses, which is the analytics of finance. Can you see my screen?
Yes, sir.
Yeah. So this is the one from which I am going to show you the arbitrage free pricing models. You should take a look at these things. I have already downloaded that, so I will show you here. So some of the slides, which are quite nice, some of them are like recap to the Pliska material that we have covered, but there are some additional discussions which are quite informative. So this is the definition of arbitrage, more or less in a similar manner. And it talks about the fundamental theorem. So this is the first formal result. We already know this, that the absence of arbitrage will basically lead to the positive pricing measure, which is our Q. So here the notation is slightly different. Here they are calling it pi, but it doesn't really matter. And they have a result which shows the relationship between the expected payoffs and the price today in a really dynamic model, because this is something that we haven't discussed yet, but we are going to do either today or next Monday, when we are going to extend the model to multi-period. So there are many periods where we can take decisions. So this is something that you should start looking at, because we will get back to this point. So it also gives a proof of this result in an intuitive manner. So that proof we should take a look at, because very often I won't do the proofs, because either they are easy for you, or maybe the details are more or less routine and you can follow them yourself. Arbitrage-free models is discussed also, and how it is related to the state price density. So SPD is state price density. So that is another point that is important. There is the definition of a risk premium and how it is related to the state price density through these equations. So again, you have to remember that here pi is actually Q. So a little bit of notational difference. And then the conditional risk premium is defined like this. And we are moving to the capital asset pricing model. So the capital asset pricing model again is defined through the linear regression here, which follows more or less similar notation, but we have to take care because it's a dynamic model here, and the pi q nomenclature is different. Okay, so multi-factor I'm not going to talk about right now. Then it goes on to risk neutral pricing, which we have mentioned, but we will get back to this again in more depth. How to find the right price for any contract. It also talks about risk neutral measures, which is our Q probability, how it can be constructed in a dynamic model. More details. Change of measure, we will come to that later on. And when we move on to the continuous time model, we will actually also get to the normal distribution and show a connection between the normal distribution setup with our pricing strategy. Please mute yourself. Some noise is coming. Please mute yourself. Okay. So this is one part of the material which relates to the arbitrage-free market structure that we discussed, which you should go through because these are really nice slides. That's one set I wanted to mention. The other set is about the mean variance analysis and the utility maximization analysis that we did on Monday. So first the mean variance analysis comes here. So this is actually due to Harry Markowitz. So it is actually called the Markowitz mean variance analysis. Similar notation, but what I call capital N is called M here. So M risky assets. I have the return vector, capital R. This is the mean and covariance matrices. And my portfolio problem is defined in the same way. So I look at W prime alpha and W prime sigma W. And then it's a risk minimization problem. I minimize variance subject to a target return, which is given here. Notations are different, remember, but you can understand very easily. So the solution is explicitly shown here. This solution I glossed over. I did not talk about the details, but this slides actually sets up the Lagrangian and explicitly shows how the solution happens. So if you want to check your understanding, you can take a look at it, but I am sure you all are familiar with this. And once you go through the whole solution setup, then you can find the optimal values. The optimal values can be actually plotted, and the locus gives you a hyperbola, which is given here in matrix notation, but it is actually a quadratic form, so it gives rise to a hyperbola. We can also, as I said, we can also think of this problem in the reverse way. We can fix variance and then maximize expected return. That version is also discussed here. We can also allow the risk aversion. Risk aversion we have discussed through the utility function. So that I will move on to next. But one can actually show that the mean variance setup and the risk aversion setup, the constant risk aversion setup, they are related. And the relationship is, okay, so before I go on to that relationship, there is another part with the risk-free asset with the bank, but that we have already discussed. So again, the Lagrangian problem, how to solve it, etc., etc. So this would be the final solution here. And from that, you create the market portfolio, and the market portfolio then gives rise to your two-fund separation theorem, which is actually attributed to Tobin, a very famous macroeconomist. So in these slides, it is called Tobin's separation theorem. It's a two-fund separation theorem essentially. So that discussion is given here in a very nice manner. So it's worth going through. These are some of the key papers. This is Harry Markowitz. This is the James Tobin's famous paper, and some other related papers where the methodology was discussed further by Sharp and Lintner. And the last one is very interesting. The last one is the Fama. Eugene Fama is the pioneer of statistical analysis of financial market. So he did a lot of extensive studies throughout his career, and this is one of the first papers that he came out with. Many of the theories that we talk about today are essentially rooted in the empirical findings through the works of Eugene Fama. So people have formulated theoretical models looking at his empirical results. So these are very important and celebrated papers. Most of them are freely available, so you can take a look at them. Now, going back to the utility formulation, this is called the von Neumann-Morgenstern utility theory, where utility is understood under uncertainty. So what we are really looking at is expected utility, and typically we want to maximize expected utility. So in that setup, we have already discussed a little bit. So let me quickly take you to the risk aversion measures that we mentioned on Monday, absolute and relative risk aversion. So these are the measures. And as I said, if you think of the utility function as sufficiently smooth and you take a second order Taylor series approximation, then we can show that this utility setup is equivalent to the quadratic utility, the quadratic mean variance setup that we discussed in the Markowitz area. So this is the connection that I expand the utility function, ignore terms of the higher order, so I can approximate it using the quadratic expression. So in a way, at least approximately, the utility setup under uncertainty can be identified with the quadratic, particular choice quadratic utility in the mean variance analysis. And again, these are the some of the popular utility functions. This one is for the mean variance analysis, quadratic utility. Linear is not really any good because linear is really not very nice. The second derivative becomes 0. There is no concavity actually. These three are the ones that I mentioned on Monday. The exponential utility for constant absolute risk aversion, the power utility and logarithmic utility for constant relative risk aversion. So the last three here, they are the most common and popular utility function choices for any mathematical finance examples. But if you are in the mean variance optimization setup, then you are essentially looking at the quadratic utility. Yeah, okay. So I think that's more or less what I wanted to show you from here. No, yeah, little bit more. In the end, we talked about the constraints that are actually imposed on the feasible set of portfolios in real life. We said that there might be restrictions on short selling, there might be restriction on priority investment, restrictions on taking loan from the bank, etc. Right? So that's the discussion that is mentioned here. So this is the, the setup we started out with, that there is no short selling. I can only buy positive quantities of a stock. So all the weightages has to be non-negative. Now, in addition to that, there might be other constraints, like I may be restricted to hold a minimum of some asset and a maximum of some asset. So there might be a lower bound and an upper bound on the asset holding for each asset. So then I will not be working on the unrestricted positive orthent. I will be restricted inside a cylinder or a smaller rectangle. So these are possible constraints. There might also be constraints on how much I can change in 1 unit of time, because changing my portfolio is expensive. So there might be a restriction that I cannot change my portfolio weightages by more than, say, 5%. So those are called turnover constraints, and turnover constraints are essentially on the change. So I look at delta Wj. Again, so notation is different. We were calling it H, here it is W, so that's okay. So the change can be at most a number Ui for asset. Some asset, I can at most change it by U amount. So these are turnover constraints, which are also sometimes imposed on our portfolio optimization problem. There could also be some benchmark exposures, in the sense that I may have to stay close. I may have to stay close to some prescribed weightage. So WB is my prescribed weightage. I can move away from it for my individual benefit, but the movement is restricted by an upper bound. These are called benchmark constraints. So these are different alternative real life scenarios that are often encountered when we work with real data, and then our optimization problem has to be modified suitably to incorporate such constraints. And we have talked about a general setup already on Monday. So the idea would be to show that these constraints can be fitted in with our general setup. And then we can go about solving it. Maybe numerically, but solving is possible. Okay. So again, this was the review part, because I wanted to show you this nice material. Are there any questions on this one? Anything that is not clear? All of these materials are also in the Dropbox, so you should be able to access them whenever you want. So all these websites, these links, and the material I already put in the Dropbox. So you should be able to access them. So no questions? So these are the links that I am showing you now. These are the links, and the pages are here. This is one of the courses, and this one is the other course. So these two courses I mainly wanted you to look at. So these are the two things. All right then. So then let me move on to the next chapter. So we have already discussed this chapter 2 results. Now, let us start talking about the extension to multi-periods. So more than one period. So we started out with the simplest single period market where I had only 1 day time zero where I can make the investment decisions, and then tomorrow at day 1 the consumption will happen. But now I want to really extend it to a more reasonable scenario where I have capital T many dates where I can take decisions. So the notation is like this. The dates are time 0 to capital T. Okay, so I'm sorry there is some noise going on. So can you hear me clearly? Can you just confirm that you can hear me clearly?
Yes, sir. You can hear me.
Yeah, because there is some noise going on nearby. Okay. So I have capital T many days where I can take investment decisions. So 0, 1 up to capital T minus 1. And then at the last date, which is the Tth time point, consumption will happen. The state of nature will be realized and consumption will happen. So again, our states of nature are finite. Omega 1, omega 2 up to omega k. There is a real life probability P defined on omega. And because later on we are going to make these restrictions and all, this time I will start with a strictly positive probability anyway. Because we have already gone through that discussion that if I put 0 weightage, what will happen and so on. So let us start with a strictly positive probability. And the first new structure that is required for a multi-period market is the following. Now you see, when you had only 1 day to take decisions, there was no scope of a revision, or there was no scope of further information revelation. But in a multi-period scenario, when you are going to take decisions capital T many times, obviously you will be receiving some information also. Otherwise, you would not really need to change your decision, because decisions are essentially dependent on the information that you have. So if your information remains the same, then whether I talk about a single period market or a multi-period market does not make any difference. So what we are talking about now is essentially every day some information is becoming available, additional information. And that in our probability language is described by a filtration. So a filtration is nothing but a collection of subsets. And here we are in a finite state of nature. So describing the collection of subsets is also quite easy. So what happens is on day 0, I am working with least amount of information. So then my collection of subsets is a very general one. So almost anything can happen. So almost anything can happen. So that's a very big set. But as I move on from one time point to the next, because of what is happening in the interim periods, some of the possibilities will get ruled out. I will see that, okay, some of these things are no longer possible, so I'll be able to refine my set of possibilities. So I describe it in this following decreasing sequence of collection of subsets. I start from F0, which is the biggest one, and I slowly move until I reach time capital T, when it becomes a singleton, because we already know that at time capital T, the state of nature will be actually realized. So I will know that exactly what is happening. So in the end, I have a singleton, but this is not a one-shot change. The change happens progressively through time. So is that clear? So if you have done the formal stochastic process course, you have also come across the filtration definition in a more formal setting.
No, sir, we haven't yet.
You haven't yet, but you will definitely.
Yes.
And then after a few days of confusion, you will be able to see the connection. Because the filtration I am describing here is essentially a very simplified version of the same stochastic process filtration. Again, I am deliberately keeping it as simple as possible, and also Priska has kept it as simple as possible. But when we get on to the continuous time setup, we will see that we have to really be more formal and talk about it in a more comprehensive manner. But for now, this is sufficient. So I have this filtration, which for the time being, you just take as the set of possibilities. And as I go along, I am able to rule out some of the possibilities. So again, I have the bank process, but now the bank process will give me returns every period of time. So I have
in general, filtration isn't filtration defined as the sequence of sigma field, is that the sigma field is getting finer and finer.
correct.
So F2 will contain actually F1.
Sorry, yeah,
Yeah.
I understand. So you are looking at it from the other way around. So that's why I said there will be a little bit of confusion initially. What is happening here? So when you look at a progressive sequence of sigma fields, you are still looking at it from one. There is no really movement there. So you are looking at it from the time point 0. But here we are looking at it from the interim time points.
So you are looking at it as a set rather than a sigma field, collection of bags.
Yes, and for this finite setup, it will work. As soon as I get into an infinite setup, then what you are saying, I will have to connect it with that and make it more clear. For now, as I said, because K is finite, things are very easy. So all I am faced with is the power set. All right. So is that clear, Ravi, or are you asking something?
Yeah,
Yeah,
it's
for
clear.
now. So that connection will become clearer as we go along. Okay. So the bank process, I now have to define it as B0, B1 up to B capital T like that, because every period the bank will pay me some return, some rate. Again, B0 is of course 1, and I define the rate of return like this. So for time point T, the rate of return is BT minus 1 divided by BT minus 1. That's the standard return definition. For many applications, we will assume that RT is equal to R. So every period I get the same rate of return. But for a very general setting, both T and omega can change R. So RT can be a function of T. It can also be a proper stochastic process in the sense that I can also allow the bank process to be state dependent. But for all our development subsequently, we will keep it constant, so that our expressions are relatively simpler. We may sometimes allow R to be a function of T, but a deterministic function. That's all. So we are not really allowing R to be a stochastic process here. The risky assets, similar notations. I have capital N many risky assets, and now the profile of each stock has to be described as a stochastic process. So SNT for T equal to 0 up to capital T. All right. And explicitly, I now assume that SNT is non-negative. I am assuming that a stock price can never be negative. This is a very standard assumption in finance, which is called limited liability. It says that I can never be liable for more than whatever I have. So if I have very little, you can take only that much from me. You cannot ask me for more. That's why there are defaults. I may have more loans than I have assets. In that case, I will not be liable to give you the whole amount of the loan back. I will just sell all of my assets. Whatever I get, I can give it to you. So I can never go to a negative situation. Is that clear?
Yes, sir.
Okay.
So when that thing happens, that someone is going bankrupt and the entire thing is not getting paid, then who is paying for that?
Unfortunately, nobody. Unfortunately, nobody. In a limited liability setup, if a company files for bankruptcy, then what will happen is all their assets will be sold off and the money will be used first to pay off the debt holders because they get the first cut. If the money is not sufficient to pay the complete loan, then a fraction, uniform fraction will be paid to everybody. So even if you have given 1 lakh rupees loan, you have bought a bond for 1 lakh rupees, you may end up getting only 90,000 rupees. So other 10,000 is not going to come back to you. That's the reality.
So that money is essentially lost on the market.
That money is essentially lost. Yes.
The total sum does not remain even constant. It can go down.
It can become less than the principal.
Right.
It can become less than the principal. Even though I may have been promised a 10% return, eventually I may get even less than what I have initially invested. It is possible. So that is the limited liability setup. I can describe my stock price process as SNT omega as a proper stochastic process from 0 to capital T cross omega to the positive real line, because I am assuming SNT to be non-negative, so I can write R plus here. The next feature that I want to talk about, again very informally, but this is again has a formal counterpart in the stochastic process theory, is that I assume SNT omega, this process, to be FT adapted. So how many of you have already come across the definition of this? Because some of you have learnt about filtration. At least Ravi asked me some question just now. Is this definition known to anyone? Okay, I guess not. So FT adapted means essentially a condition on measurability, which I don't want to get into now because some of you may or may not know the formal language. So what it essentially means is that if I want to understand the probability distribution of SNT omega for all omega, I can use all the information that is available to me up to and including time t. So as I go along on my timeline day to day, as I gather more and more information, I am essentially calculating conditional probability distributions. But I cannot look forward. I cannot anticipate. So in terms of information, that is what it means. In stochastic process textbook, you will see a more formal definition for adapted stochastic processes. Any questions now at this point? Ravi, do you want to tell me something?
No, I mean that's what I was saying, trying to say that Sn as a random variable is measurable with respect to the sigma field Ft.
Thank you. That is the formal language. I do not want to use it right now because some of you may not be familiar with that, but that is the right language. Okay. By the way, if there are any questions regarding stochastic processes, I also have this lecture slides. So again, from this MIT Open Courseware, this particular course that I showed you here, this course here, I think, no, the other one. This one, this course, can you see? Can you all see this?
Yes, sir.
Yeah. So here I particularly mention the two lectures, 5th and 17th, lecture 5 and lecture 17 here, which are on stochastic processes. And if you want to brush up or if you want to look up the new concepts, this is a good material. So do take a look at them. I think I do have them here. So I will just show you lecture 17. This is the second lecture, which is on the continuous time stochastic processes, because the formal language will come here. The formal language will actually come here. And if you want to look at the more basic material, then you have to look at lecture 5. Lecture 5 is the simpler material, and it starts with a discrete setup. Starts very intuitively, but then it builds on the formal language. So I definitely recommend that you look at these two lecture notes on stochastic processes, because that will give you a very nice overview of the terminology, concepts that we are going to use in this course. But I am not going to give you any formal definitions as far as possible. So this would be your core material. Okay, so I think I will stop here and we will continue on next Monday. But two things. One is, do look up the first two chapters from Pliska, look at the examples and exercises, because I need you to ask me questions. And second is, look at this additional material from this MIT OpenCourseware. They are really nice and they would help both you as well as me, because then I will know that you have a primer on whatever background concepts that I want you to do. All right. So if you have any questions right now, you can ask. I'll stop here today. So I see that Rajesh has been able to join. So Rajesh, your line is working now?
Yes, sir.
Yeah. So have you been able to access the lecture videos?
Yes, sir.
Yeah. Okay. So you take your time. Once you are through with them and you have questions, then you can discuss with your classmates, of course. And if you want, we can discuss separately also.
Yes, sir.
Yeah. And is Abhishek Bhadro around? Do any of you know how he is? Any of you know about Abhishek Bhadro?
I don't think so. There's anyone named Abhishek Bhadro.
No, actually, there is one student who said that he is COVID positive, so he will join.
Panda. Abhishek
Abhishek Panda.
Panda.
I'm sorry, Abhishek Panda. I'm so sorry. I'm so sorry. Yeah, my bad. So where is he now? How is he now?
I talked to him 1 week back. So, and then he said he was fine. But it's been a week since I've talked to him.
So when do you think he should be able to join classes?
Maybe a week or two.
Achha. Then one other question. I don't know what is the deadline for you to let us have the final choices. Who among you are going to take the course as credit, and what's the deadline?
The deadline is not mentioned. Like, we're not told any deadline. For
As long as the dean's office is not asking us, we have to be quiet.
And what happens if I am asking you?
Then we do not have that
You can-
choice.
See, my problem is that I want to assign work to students, maybe in groups. So unless I know exactly who are the credit students, I will not be able to start that assigning.
Even the non-credit students have to, I mean, if if they're taking just for non-credit and not for audit just, then also they are supposed to get marks. It is just that their marks would not be added. So
Okay,
the entire
but are there anyone here who is auditing? Because I know Srijit told me that he wants to come sometimes for fun, which is absolutely okay with me, but I will not assign work to him. So are there any other candidates who are just auditing? Because then I will exclude them from the assignment list. Anyway, so it would be nice if you can let me know by Monday. Because then next week we will start talking about assigning work. Because I don't want to give everything at the end of the semester, because then things pile up. It is better to take things gradually. So Monday is fair enough. Can you do that for me? So now no one is willing to commit. So this is the prisoner's dilemma situation.
Hello. Yes, sir, we can try.
Yeah, please do try. Okay, sorry. All right, so let us stop here, and please try to give me the choices by Monday, and we will resume on Monday then.